everybody. Today is Monday, May the 5th, 2025, and I'm going to do part two of our tariff talk in 2025. I am John Blank. I have a PhD from MIT in economics, and I am Zacks Chief Equity Strategist and Economist. So before we get on this adventure today, let's talk about the disclosures. These views today are mine, John Blank. I do have a PhD in economics, and they are not necessarily the views of Zacks Investment Research. Go ahead and read the rest of this at your leisure. So, step one in our process today, we'll look through a variety of macro charts and perspectives on trade, tariffs, and foreign exchange rates. We'll also get into some equity markets and bond markets and ISM type perspectives on this trade situation we find ourselves in. Okay, so number one in the second part is we're going to talk about intellectual property rights and types of what are called industrial property rights, IPRs. Now, intellectual property rights are over on this side, and industrial property rights are over on this side. Now, I want to point out what are intellectual property rights. This is really rights given to people over the creations of their minds. So these are customarily divided into two areas, and one, of course, you know quite well. It's copyrights and rights related to copyright. So this is authors and artistic roots. Think about books and writing. Think about music, painting, sculpture, computer programs, actually, and films. They're protected by copyright for 50 years. Also protected by copyright are rights of performers, actors, singers, and musicians, sound recordings, and broadcast organization. So we want to protect creative work is basically what's going on over here. Second part of this is industrial property rights. This is your trademarks, right? Those are ones that distinguish a good and service, so you can protect your trademark from other people using it. This, of course, will play a role in the environment of international trade. Of course, someone in China can take your trademark and produce your good. Think of Nike. It would be a good example of that. So the other thing we can look at is, things that are protected by patents. This would include inventions, of course, industrial designs, and trade secrets. The social purpose of this is to provide protection of the results of investment and development of new technology, right? That's the whole idea here. And this should be help the transfer of technology in the form of foreign direct investment, joint ventures, and licensing. So this is about intellectual property rights and the component of industrial property rights. And like I said, think through all of this as also involved with the tariff situation. Stealing patents or not protecting patents, stealing trademarks, not protecting patents. Joint ventures, whether you allow them or not. Licensing, think about batteries in China. And copyrights, of course, all the creative work that goes back and forth across borders. All right, so to protect all this is this thing called the TRIPS Agreement. It was issued by the World Trade Organization in 1995. The TRIPS Agreement is trade-related aspects of intellectual property rights. So trade-related aspects of intellectual property rights. Key WTO agreement that established the minimum standards for protection among nations. So if you join the WTO, this is the minimum. The TRIPS are the minimum standards. You cannot be lower than these ones. So what it gives you is, patents, copyrights, trademarks that are minimum standards across countries. Pharma patents, public health patents, compulsory licensing of pharma patents in health crises. So, COVID would be an example of that, where there might have been some compulsory allowance of patents so people could use COVID vaccines. Protects products linked to specific regions. So Darjeeling tea, of course, that was from India, and that's an indication of the good that you have to produce this type of tea and grow it in India, in that region of India. So also encourages transfer to developing countries. However, there are challenges in implementing it effectively. So the source of all this, WTO.org. So lesser known issues, biopiracy. indigenous knowledge often exploited without compensation. So, for example, we go to the Amazon and talk to someone there who's in a tribe and understands certain types of plants and medicines there. Digital rights, digital platforms, online intellectual property rights, customs enforcement. Here's a big issue in trade that gets laid out here. Authorities play a crucial role in preventing entry of counterfeit goods. So yeah, you get into the trademarking, copywriting game. It's really a customs enforcement game. And here's an example. We've got Customs and Border Protection that sees counterfeit cigarettes. Of course, that would be something like a Philip Morris would care about. Um, Climate technology, green patents, but there's MRA access programs, the share extending technology with low-income countries. I already spoke about this. This is now enumerating it. That of course, if we're going to have pharma patents that are allowed in these poor countries, Moderna and the mRNA vaccine, to share that technology, not the patent, but the technology, how to do it with low-income countries was part of all this TRIPS agreement. So keep in mind, this is WTO stuff. So the U.S., how the U.S. gets involved in this, we are signed on to the WTO, and all the member countries in the WTO must follow along with the TRIPS agreement. Again, this is arcane stuff until you get in a tariffing war. And why we're discussing it is because we're in a tariffing war. And these where we are, unless we leave the WTO, which I generally do not think will happen, we are obliged to abide by these types of rules. Okay, so now we're getting into the Trade Act of 1974. This is a piece of U.S. legislation. It grants the president the authority to negotiate trade against other countries, aiming to reduce or eliminate trade barriers. To reduce or eliminate trade barriers, not to create them, okay? So it provides a trade adjustment assistance program to aid workers adversely affected by foreign trade. So another issue here is, if someone loses their job from a trade act, whether they get paid from an act like this. This is really quite old. Remember the WTO Act, the TRIPS Agreement, 1970, 1995. This is 1974. So in the early going, we did want to reduce or eliminate trade barriers. That was the idea. So trade points from Section 301, 306, and what's called Section 310, intellectual property rights protected. This is over here. This is Section 310. Now, again, we're talking about intellectual property rights as they're protected in trade here. Before we just talked about intellectual property rights. Now we're talking about them in trade. So global theft, tech, pharma, and entertainment, we've talked about that. Section 310 is used in trade negotiations. The annual U.S. Trade Rep report based on Section 310 identifies countries with inadequate protection. So Special 301 report, the Special 301 report will identify countries that are not living up to the standards that this law requires. China is a key focus of Section 310 scrutiny and enforcement. I laid it out right here. So it's already been an issue going back 50 years that China was a key aspect of this whole theft of intellectual property. Over here, we've got 12-month deadlines for completing investigations. So I put this, there's a lot of other things to look into, the authority to enforce trade rights, initiating an investigation, but I thought it was most important to point out, you have to get these investigations under 301 or 306 to see if you're complying and done in 12 months. You can't drag this out, basically. Keep that in mind. And this is all about what the U.S. Trade Rep, the USTR, is our organization. The U.S. Trade Rep imposes tariff quotas and unwritten restrictions. The U.S. Trade Rep decides what retaliation to take, and the U.S. Trade Rep monitors foreign countries. I've heard a lot from the president on trade, but this is the U.S. Trade Rep. So keep this in mind. Again, this is a lower level position within the government that handles this type of thing, and it operates under these types of laws. Think of this like the Federal Reserve Act, that the Federal Reserve Act acts under. This is the U.S. Trade Act, and the Trade Rep acts under this one. So that's how you want to think about this. Okay, onto the GDP and for these tariffs. Where are we? What is going on? I just want to point out the very basic stuff up front. 0.8% total loss of GDP from our unilateral actions already. Another 2/10 goes from retaliation that is expected, and that gives us a 1% loss in GDP. So we did 2.8% last year in 2024. If you think this impact is correct, we go to 1.8% this year. So we lose basically, a third to 40% of growth for the year in imposing these types of tariffs. So let's go through what we've done already. This obviously can and will change. There's no doubt about it. We're pulling this out of Budget Labs at Yale. Tariffs on China, of course. All imports 20%. Most imports are 145%, but they're an exclusion list, and that means they're averaging 145% of most goods from China. The exceptions are the Section 232 and exclusions items. So this is, do we know what is really being exempted here? We don't, but we can assume 145% tariff on China is extraordinarily high. Extraordinarily high. Tariffs on Mexico, 25% in 2025, reduced to 12% after 2025. What's the logic there? Honestly, don't understand it. It's the USMCA compliant imports that are exempt. So again, this will be a lot smaller number because the USMCA has been already negotiated. This is the things outside of the USMCA, which is not much. Mexico will actually end up being in okay shape because of, again, reading all of this is key with the exemptions. Tariffs on Canada, 10% on energy and goods, 25% on other goods in 2025, goes to 12% after 2025. Again, USMCA compliance. Again, not going to be as much as you think. Global baseline tariff, 10% on all countries, April to June, higher rates for later for 60 countries. Again, we'll see if this really happens. Annex 2 and electronics restrictions. We've already heard about the iPhone and that type of stuff. 10% baseline, up to 20% EU, 12% Canada, Mexico. Like we already talked about this. So again, we got the 90-day exemption through June, and then higher rates later for 60 countries. Let's see if that happens. If it does, I think the stock market will go down. Section 232, steel exemptions, ends the exemptions, expands tariff coverage on all of this stuff. Aluminum ends exemptions, 25%, expands tariff coverage. Auto parts, 25% on all auto parts, excluding U.S. content from Canada and Mexico. That's be the foreign automakers making stuff in Canada and Mexico and shipping it up. There are a few people doing that, well, actually, a fair number. But again, if it's USMCA compliant, it will be exempt, and I assume a lot of that will be the case. Retaliation, tariffs on $330 billion of U.S. exports. If fully implode, of course it doesn't, we don't know that yet, and the combined effect will be 1%. So that's where we're at. So existing trade agreements, lots of different rates that play out in 25 and that could go away. The big play, of course, is in China. This is the major source of stress in the U.S. economy right now. Again, this will be subject to change. Time effects of all of this stuff. So first thing, when you reduce imports, you decrease demand for foreign currencies because you don't buy as much. And it can strengthen domestic currencies. Tariffs can increase demand for domestic currencies and capital, but however, capital outflows due to trade tensions are longer term. So short term, you have a stronger currency. Long term, you have a weaker currency. And do we see this? So over here, we got the Japanese yen and grain and the Mexican peso. And you can see from January on, they both got stronger because money was flowing out from the United States into Japan and then to Mexico and away from the United States. Here, the euro goes down, gets stronger. The Indian rupee does too, but in a much more dramatic fashion later on and not as early. The yuan is kind of the exception here. It's meant to manage float and it's bouncing around wherever it wants, somewhere around the 7.3 area. The Chinese manage this and they can manage it down, by the way. And when they're out of alignment, they will do that. The Canadian dollar is in sync with the euro and with the yen and the Mexican peso. So the general rule is the US dollar got a lot weaker because as time went on, longer term capital outflows have been happening. So again, that makes our goods more expensive in these countries, which reduces our exports. So keep this in mind. We have an FX effect that is hitting the United States, and it has to be included as part of the headwind of creating a tariffing situation is money is leaving the United States, causing our currency to get weaker against the yen, the peso, the euro, the rupee, and the Canadian dollar, and at some point, maybe the yuan. I expect they would depreciate as well. That's what's going to happen. It's already happened, and I assume these trends will continue to make the dollar weaker and weaker in these areas of the world. We'll see what goes on, but that's what these charts tell us. Okay, Mexico, all these different groups. We just want to point out here, this is looking back over 2024 and into 2025, the equity markets for US, Mexico, Canada, Japan, and China's lesser known industries. And you can see, of course, the big April 2nd pull down in all these equity markets. And then the big rise afterwards when all these exemptions took place. And of course, Mexico is the most dramatic rise, and it's been giving the most bid. So you have to assume the Mexican story has turned out actually fairly well for people out of the other stories that are in hand. The market is telling you that. So what do we have? We have an uncertainty response. We have an impact on profits, of course. We have an impact on global growth, and we have sectors that are much more likely to be hit: ag, tech, and manufacturing in particular. This is a goods business. Those are goods production. Ag, tech, and manufacturing are what's getting hit. But the basic point here is, we've heard a lot about, international stocks doing better than the United States this year. But this chart doesn't speak to that being as strong as you might think, and in many ways not very strong at all. Because this is a global event. It is weakening global growth. It is not helping anybody outside the United States, and is yet to be seen as something that's helping the United States either. That will remain to be seen. Okay, long-term treasuries. One thing I want to point out here, this is gold and silver coming up for 2022 and 2023. This is all about a pre-existing restriction in the international economy that you have to keep this in mind. This is probably the most different thing this time around with the Trump's era 2 versus Trump era 1 is that Ukraine is in a war with Russia. Russian sanctions are being heavily applied, or anybody does business with Russia, by Europe, United States, and with many other countries. And that's forcing both the Chinese and the Russians into gold and silver. And so keep in mind, trade restrictions were already in place for a lot of these countries and were been ramped up for these countries the last 2 years because of the Ukraine war. And that predates this administration. Keep this in mind. This is all Ukraine war related. This is really important that, you got to remind yourself that something has already happened and we've already seen deglobalization taking place because of Ukraine. And it's probably going to keep going until that war is over. And I don't think anybody should bet on that anytime soon. So these are the interest rates of the various bond markets. Here's the 20-year and here's the 30-year, of course. They did pop up for a bit. Now they're back down. A lot of worry here. Again, basically not showing you much real movement. One movement that does seem the most salient is the 5-year yield. The lower term yield has gone from 4.4 to 3.7. That should actually benefit housing markets and auto markets. Auto loans are priced 5 years. So again, we're seeing a lot of different things going on here. Here's the market response. There's yield movements, central bank actions, inflation growth go up and down, and there's a flight to safety. But again, I think the main point here is this Ukraine thing. There's already been deglobalization. All right, so over here, I want to just point out the ISM Manufacturing Imports Index is this blue line. And so it did go down to 45. And 45 generally is the line where there's real change and real differences. So, however, it's at 47. It's not that low. I've got the new export orders at 45.8. That is low. And the new exporters index is 43. So the main thing to look into here is the export orders in the IMN are much lower than the imports because, of course, we're still importing a lot and trying to get in front of this. But the export orders have come down dramatically, and that is part of it's dollar related. Things have gotten much more expensive here. So keep in mind, we've already seen more, from the ISM perspective, much more damage to our exports than to our imports. Keep this in mind. Capacity utilization has remained high and will probably likely do remain high. That's all domestic related. And non-manufacturing, of course, is staying about 50, while manufacturing is 49. That's not material. It's basically not telling you something. Over here, you're getting a better story. That's why I've circled these things. Exports are already down more than imports for the United States. There's our money supply issues and other stuff about price indices. Just want to point out that export prices really went up during COVID. And so import prices came up later on as we exited COVID. Now they're basically climbing back up again, which is unwelcome. All right, so now let's get to the positive and negative effects from the trade plan that is in place. All right, first off, I just pulled this out of the Bureau of Economic Analysis for its first quarter. Of course, you've all heard about the loss in GDP growth. Now, it is important to understand what has already happened in Q1 to understand the macro effects that will be ameliorated for a piece of time. So why are the markets kind of calm right now? It's about these ameliorating effects for a piece of time. So I want to point that out. This is a key point. People knew the tariffs were coming in, and they bought stuff and shipped it into the country before the tariffs were imposed, or shopped before the tariffs were imposed. So that's going to buy you 2 to 3 months of time where the macro effect will be ameliorated for a piece of time. What I mean here is 2 to 3 months, probably the second quarter will be okay. Into the third quarter is where you get an issue, because what's going on here is not a recession. It's people front running the tariffs. And so what you see here is this reflected an upturn in imports more than anything, and then a deceleration in consumer spending and a downturn in government spending. That was partly related to what was going on in the Doge situation. But there was upturns in investment and export. So basic point here, the bottom line in most of this was people bringing imports into the country. The real measure of the economy is real final sales to private domestic purchasers. That stayed at about 3% compared to 2.9%. So the actual economy outside of this tariffing situation stayed on track at a 3% growth rate. I told you 2.8% was last year's number, but the first quarter was actually, in this context, slightly stronger than the fourth quarter 2024. So what's going on here is people are trying to ameliorate the effects of the tariffs for the second quarter, and they achieved that by moving the imports in the first quarter. That's all that's happening here. Keep this in mind. Okay, so what do we have here in terms of positive impacts? Of course, there will be some leverage in negotiations. We'll talk about the USMCA as part of that. That happened before. It came out of the negotiations that the prior administration in Trump's era did. Reshoring and manufacturing, we'll see if that happens. And it does highlight in trade imbalances and raise public awareness. Obviously, we're doing this discussion, and that is creating this knowledge, and that is a positive. Now, the negative impacts, of course, lots of uncertainty. Nobody knows what's going on. There'll be job losses. There'll be retaliation for China, EU, and the others. And of course, it's going to increase production costs, making many groups in the United States less competitive because a lot of imports are inputs to production, and it will make it more expensive. So keep this in mind. There are and will be negative effects: job losses, input costs, uncertainty, and retaliation all come to play here. Okay, and now we've got even more stuff to talk about. Um, we'd like to get the imports down. That's what would like to be happen. We'd like to diversify away from China towards Vietnam and Mexico. It's already been happening anyways. However, the negative effects. Overall, as you saw with the ISM Export-Import Index, there will be a decline in trade activity. That's more deglobalization on the back of the Ukraine situation. And this is probably the most important thing to remember. Tariffing is international relations. Tariffing is international relations. It does influence diplomatic trust. It does erode cooperation, and it does put a strain on our alliances in a military context. This is critical to understand as a negative effect. Trade is always part of a lot of different diplomatic things, aid, uh, commerce flows, um, any type of military cooperation, government cooperation, alliances, military alliances. Think of NATO. Okay, and the big bear out there is Torsten Slok. He's the chief economist at Apollo Global. And he laid out a bear case of an imminent 2025 recession. And he did this last week, not before last week. And he calls this a voluntary trade reset recession, and he puts it at 90%. And this is the mega bear case. So by midway, he says the movement of container ships will come to a stop. Later that month, this month, demand for trucking will also grind to a halt. That will lead to empty shelves in stores. Companies will force to respond to declining sales will be layoffs at retailers, trucking companies in later early June. By summer of 25, that will equal a full-blown recession. The administration inherited economy with strong growth, 4% unemployment, positive hybrid stem to tailwind investments. Implementing extremely high tariffs overnight hurts many businesses, particularly, and this is key, small businesses, because the tariff must be paid by the businesses when the imported goods arrive in the U.S. Small businesses often do not have the capital to work tariffs into their costs. Expect ships to sit offshore, orders to be canceled, and well-run generational retailers to file for bankruptcy. And small and medium businesses make up 80% of U.S. employment. So he calculates that increasing the tariff from 3 to 18% will negatively impact by 4% in 2025. So 4% is not 1%, folks. That will definitely drop us into a minus 1.2% recession, right? We're at 2.8, 3%. 4% will take you to a minus 1%. So 4 percentage point does not mean minus 4% recession. It means a minus 1% recession in 2025. Earning outlooks are already showing their sharpest decline since the pandemic. New orders are collapsing. I showed you the export orders and import orders. And manufactured carts are already on the rise. Truck sales particularly declined sharply in March. Okay, so this is the basic idea that the small businesses will not be able to pay these tariffs and will either not order or shut, and medium businesses. So this gets us to my next chart. Do we see anything that establishes this? In the ADP private employment, this is from May the 1st. The green line at the top is 250 to 249 employer firms. Now look, you got 1, 2, 3, 4, 5. So these are these groups, which are not the biggest groups. Those are down here, the next biggest groups. And then at the top, of course, we've got this group, and they do show a big drop during the COVID pandemic. Who Torsten Slok is worried about is the 1 to 19 employers, this group. And he is right, that's 35 million employers, and they do show a drop during the COVID pandemic more dramatically than others. Now, here is the group of the biggest companies, and you can see his point here. They're less of the employment base, and they drop it less dramatically during COVID. So interestingly enough, it's the very, very small startup companies that will drop out, and then these middle-sized 250 or 50 to 250. So it's the 1 and 3 here, these two, that are the real at risk. This type of group here, obviously they've got some traction. They may hang in there. But his middle size and small size companies, those are where the big dips. And it's the biggest dip is actually in these 50 to 250. I suppose the answer there is they've grown big enough that they just cut back. And they have so many other reasons to do it quickly and not go out of business. And these groups just flat go out of business, which is much more dramatic. So this group here is the big group to worry about. So 250 to 449, that's down here, and 500 plus, that's down here. And you can see his point. They don't drop as dramatically. So this is corroborated with Torsten Slack that it is the small and middle-sized businesses, 1 in 19 employees, 50 to 250, that are most at risk here. And they can do a dramatic downturn like COVID. That's all he's saying. He's got this to support him. So my advice here is to read the actual ADP report every month and track this type of motion in these two types of areas and see if Torsten Slack is right month to month going forward. That is my actionable advice to all of you. Okay, I hope you enjoyed this discussion of tariffing today. It's much more complicated and interesting than you might imagine. And you can now just parse the news a lot better about what's going to happen here with the U.S. economy and under many different scenarios that are out there. Minus 1% growth, possible minus 4% growth, even a recession by summer, if the small and middle-sized business cannot absorb these costs. And that is Torsten Slack's thesis. All right, get these slides from us, and it's a lot of detail here to read. 866-794-6065. Send us an email at strategycall@zackspro.com or find us on the web at www.zackspro.com. A LinkedIn page, Zacks Professional Services, and we're on Twitter at ZA Tools. Best thing to do, send us an email, strategycall@zackspro.com. Next best thing to do, give us a call, 866-794-6065. Or if either of those don't work for you, just go online, find us on the web at www.zackspro.com. I hope you enjoyed this. Thanks much.